Welcome to Friday Takeaway. This week I analyse two companies embroiled in lawsuits, Genting and Malaysia Airports. But first, this blockbuster. In yet another sign that the US-China trade spat seems to be escalating, Microsoft's Bing search engine has been blocked in China, rendering yet another Western internet service inaccessible to the world's largest online population. Bing had been allowed to operate in China because it censors results, but this week was rendered inaccessible, a government block which Microsoft later confirmed to be true. Bing was blocked on the instructions of the Chinese government, the Financial Times reported, while other news sources noted that any action against Microsoft could set off alarm bells for other US tech giants like Apple, who now rely on the Chinese market for profits. High-end household appliance maker Dyson has moved its HQ to Singapore from the UK, coinciding with its pivot into becoming a maker of electric vehicles. Analysts say the move subjects Dyson to less rigorous financial disclosure, which is convenient since the huge capital outlay on electric cars will hurt profits. Not only that, founder and namesake James Dyson is facing accusations of hypocrisy because of his famed stance for Britain to leave the European Union. Dyson simply said the move was because of commercial reasons, since most of its customers and all its manufacturing is in Asia, and this will give its management better supervision over the construction of their car factory in Singapore that will be its largest investment to date. The Sultan of Pahang has been elected as the 16th Yang di-Pertuan Agong, following the unprecedented resignation of Sultan Muhammad V. His deputy is the Sultan of Perak, Sultan Nazrin Shah, and the new Agong fulfills a number of duties, including being the Commander-in-Chief of the Armed Forces, the head of Islamic affairs for his own state, and states that don't have a ruler, such as Malacca, Penang, the Federal Territories, Sabah and Sarawak. In this week's This or That, I look at two stocks currently having legal troubles, Genting and MAHB and Malaysia Airports. Genting's flagship development in Genting Highlands has hit a snag, but they've slapped a lawsuit on their would-be partners. Malaysia Airports, on the other hand, are the subject of a colossal countersuit by its biggest client, AirAsia. Who might come out better? Let's look closer. Genting, founded in 1965 and listed in 1971, began life when its founder, the late Tan Sri Lim Guo Tong, dreamed of a mountaintop resort in Malaysia. Today, Genting is involved in gaming, hotels, cruise ships, oil palm, power generation, oil and gas, property, life sciences, and biotechnology. In Malaysia and in Singapore, Indonesia, India, China, the US, the UK, and the Bahamas. And they use their Genting brand as well as other brands like Crockford's, Maxims, Crystal Cruises, Dream Cruises, Star Cruises. After a run of bad luck, more on that later, analysts now say that of the four listed Genting counters, the parent of Genting and MAHB is worth a bet, because it's a proxy to the still growing Singapore and Malaysia gaming and leisure markets, as well as the wildcard upside, which is the possibility of winning one of the three integrated casino resort licenses up for grabs in Japan. That's not all. Genting also has a high foreign shareholding of over 43%, who have bought into its diversified non-theme park, non-gaming businesses like plantations and property, which therefore make them very resilient to more nasty shocks in its leisure and casino businesses. The Genting Group really got hit hard last year, something analysts say was truly unprecedented. The triple whammy in 2018 were, first of all, a huge hike in casino taxes, secondly, an unexpected cancellation of its Fox theme park in Genting Highlands, and thirdly, a huge 1.8 billion ringgit impairment for promissory notes it issued to a Native American tribe for a failed development of a resort in Massachusetts. As a result, Genting's value halved in 2018. Of the 17 analysts who cover Genting and MAHB, according to Bursa Marketplace, 5 are a strong buy, 7 are a buy, 5 are a hold, and none are a reduce or sell. With a consensus target price of 8 ringgit and 90 cents, there's a potential gain of 33% on Genting stock if you buy at the current value. Malaysia Airports, or MAHB, was the first Asian airport operator to go public. It is today one of the largest airport operator groups in the world, with 39 airports in Malaysia and 1 international airport in Turkey. Its core business includes airport management, operations, maintenance and development, including from airport landing and parking fees, passenger service charges, as well as commercial activities like duty-free shops, retail outlets and hotel operations. In response to MAHB's 36 million ringgit lawsuit against its biggest client, AirAsia, for unpaid passenger service charges, the low-cost airline retaliated with a colossal 400 million ringgit countersuit alleging losses and damages due to operational disruptions at KLIA2. Specifically, AirAsia pointed to a ruptured fuel line that impeded operations at Pier P for over a month at KLIA2 in October, as well as closures at Runway 3 on numerous occasions last year. AirAsia have also stated that they maintain their stance that travellers flying out of KLIA2 should not be paying the same airport taxes as those departing from KLIA because KLIA2 provides inferior services. And AirAsia adds that MAHB has also done a poor job of maintaining KLIA2, citing the recent discovery of maggots, rats and bees at the terminal. Suit aside, there are several things going for MAHB. It's got a virtual monopoly on the country's airports with no risk of a new competitor yet. It also owns Sabiha Gökçen Airport in Turkey, said to be among the fastest growing airports in Europe. It is monetizing its massive land bank adjacent to KLIA for its Aeropolis development with retail and commercial ventures, unlike its regional rivals that are growth constrained. Some analysts have also forecast MAHB's earnings of 3% traffic growth. But if airport traffic growth hits historical norms of between 6 and 8% per year, this will re-rate the stock favourably. That's not all. There's also rising competition among the domestic airlines, which will spur more services and traffic volumes. Of the 21 analysts who cover the airline operator on Bursa Marketplace, 3 are a strong buy, 13 are a buy, 4 are a hold, and only 1 is a reduce, and no sells. With a street consensus of 9 ringgit 71 cents versus the current share price of around 8 ringgit 16 cents, there's a potential upside of 19% if you buy at current levels.